Hello, everybody. Welcome to Confident Compounding with Corey Kramer. Today, we're going to be analyzing Thermo Fisher Scientific, ticker TMO. I saw this one up on my chalkboard twice, so I bumped it up a little bit to do a little analysis for everybody. Today, as always, is not individual investing advice, just how I analyze stocks. I did post another request over on Patreon. I have a free tier over there. And I'm going to probably be posting requests almost every day here over the next month or so over on the free tier. Any of the smaller companies, I'll probably just post there. Usually I go back and try to find the person that requested it to let them know it's over there, but I've been a little lazy the past couple of times. So there's a link down in the description if you want to check out the free tier on Patreon. And then I have weekly picks over there for $25 a month as well. Check that out. And I have a affiliate link for Fast Graphs where you can get 25% off if you want to ever decide to check out Fast Graphs, which is what you'll see me using here for this analysis. All right, so Thermo Fisher, I did have an old video on YouTube from a couple years. I think it was, a couple years ago or last year. It's only about a year ago where I think I shared a recession by price in that video. I'm going to use a slightly different analysis for this one. I'm going to use the time until payback analysis, which the idea behind that is if you bought the whole company and you owned it all, you want to know how long it would take you to earn your money back from the business's earnings over time. So very similar to my other type of analysis, but it's expressed in a little bit different way. It's expressed in time, and that can help frame things a little differently sometimes rather than looking at CAGR percentages and things like that. So I use both of them, but for the YouTube videos, if I can ever do the time until payback method, that's usually the most straightforward and easiest unless a company has something that's kind of tricky to deal with. So I asked good old Google, what does Thermo Fisher Scientific do? They are in the analytical instruments and equipment business, life science solutions, biopharma services, diagnostic solutions, industrial and supplied solutions. So we've seen quite a few of these stocks sell off this year, of these types of stocks sell off. Traditionally, TMO has traded at a pretty high multiple. I remember looking at it during this run. Yeah, I mean like mid-20s, pretty steadily. I guess I could look on the fast graph and find out. Do the normal PE is 20. And then if we shorten this to more recent times, normal PE is closer to 23. So still a little below that right now with a 21, just to give kind of a baseline of what the market likes to do. Now the approach I'm using takes out market sentiment, okay? So one of the advantages is it doesn't really matter what the market has paid for the stock in the past, like what sort of valuation it is put on it. You only care about the business itself. So it's a little unique in that way. And we also should note, well, let's first zoom back out. So traditionally, this has not been a very cyclical business, right? Let's go pre-pandemic first. Earnings very steady, barely declined during the 2009 recession. However, the stock price did fall quite a bit, it looks like. Let's see if I can get it to pull up here. Down 50%. So earnings fall 3%. The stock price falls 50%. Now, healthcare in general was down quite a bit during that time because we were about to get Obamacare. People freaked out a little bit over that. And then we also had the recession going on. But it got down below a 10 PE. So we know it's not immune. The market's not immune to like just sending the stock lower no matter what earnings are doing. We could look at basic earnings too and see if there's a difference. I doubt there will be. Yeah, there's not much difference here. So that's just the market freaking out a little bit during a recession. And it's important to go back and look at that because a lot of times what I've found, and this isn't specific to this company, but all the investors that have invested in the past like 15 years or so all they've experienced until the past couple of years is just the stock price going up, earnings going up, everything's always wonderful, and that can lead to a little bit of lackadaisicalness, I guess, when it comes to what the market is willing to do sometimes to a stock like this. And we can see it's willing to go down below a PE of 10. I suppose if we would have had a recession earlier this year, well, if we do have a recession, maybe we could still see that. We got down to more like a 17 PE, so not quite there yet. But no business is immune. And history, if you can go back far enough, can give you a guide of what's possible. It's important to understand like what's possible. Because most investors or many investors won't understand, like they won't have a concept of that. So they'll get really surprised when this company goes from, or the stock loses 40%, right? Over the past 4 years. Now it's up a little bit off the bottom, but up quite a bit off the bottom actually. But if you were an unknowing investor and you just paid attention to the stock price, I mean, this is probably like a 20 bagger from 2005 to, let's see. Hey, I was right. Huge. I mean, incredible. And most of the investors that stayed in during this time did very, very well. So it's hard to take profits and easy to, and you can kind of see it in the stock price here. Like it held up pretty well, all things considered. So that's the history in terms of the recession. And then now we have the boom bust of the pandemic, right? So very clearly a big boom in earnings, and the stock price followed for 2 years, the main pandemic years. Earnings doubled during that time, okay, in 2 years. So you should expect a bust afterwards, and that's what they've been experiencing the past several years. It looks like they're basically still in it. I mean, earnings only are growing 3%. That's less than inflation. So we've had 4 years of moderate stagnation. They haven't really fallen. I mean, earnings were $12 here. They're still 22. But the longer time goes on, you know, the less the early earnings growth, I mean, the less returns you're getting, right? I mean, if you bought, well, let's just say you bought right before the pandemic. Let's see how you're doing here. So you're getting a 7% CAGR. That's probably like half of what the S&P 500 has gotten. So not really good returns during this time, even with the big boom, because it's followed up by the bust in earnings, even if though it's been kind of spread out over a number of years. Okay, so with that, what we want to know is what sort of what's it looking like now? So is this a good buy down here? And that's going to depend on two things: what you pay for the stock, which is the earnings yield relative to earnings, what you pay for earnings, and then how much those earnings grow over time. So in my calculation, in my spreadsheet, because of although we're kind of getting through this boom bust period now, so we're kind of getting back to normal, I actually used the time period leading into it to get my earnings growth rate. So my earnings growth rate is actually about 12%. That's generous because they're not expected to grow earnings 12% in any of the next few years. So I'm going to be pretty generous here, and I'm going to say, well, if they ever get back to normal, maybe they can grow earnings like they did in the past. All right, it's just that basic assumption. So I have a 12.1% earnings growth rate. This is based on pre-pandemic. And we're getting a 3.9% earnings yield. So the earnings yield is just the PE ratio inverted. So the earnings over the price. And you can see that FastGraphs is going to use a slightly different version than me. So they have a higher one, 4.56. I'm using forward earnings, and they usually use like a blended earnings. I'm not sure. I mean, I guess it was what, 3.9? Yeah, so that's not that. That's probably the main difference. There's not too much more going on there. I'm also adjusting for debt a little bit, 16%, and that'll make a difference too. So you can see that the total enterprise value is a little bit higher than the market cap. I take the difference of those which is about 16% higher, and then I adjust the stock price 16% higher, which will lower the earnings yield. Because I'm assuming you're buying the company and the debt. Basically, you're buying the total enterprise value minus cash, right? So here's what it is: total market cap plus preferred stock plus total debt plus accumulated minority interest minus cash and short-term investments. It's a mouthful, but basically, you're buying the whole thing, and you want to know how long it takes to earn your money back. I mean, very simple at its core. So we have our earnings growth rate, we have our earnings yield. Now, the way I like to think about this is if I bought the whole business for $100, I would earn $3.90 the first year. But I also do pull forward the growth rate just in my spreadsheet here. So it'll be a little bit more than that. And then the next year, you get $3.90 on your $100 plus 12% growth. And then you get to collect that. And so each year you do that. And so each year you're collecting more money. And you want to know how long it takes for that to add up to $100 amount equal to your investment. I use $100. It could be $1 billion. Doesn't matter. It all works the same. So the first year, I assume on your $100 you could earn $4.37. The next year, $4.90. The next year, $5.49, and so forth. And then you keep that each year, and you want it to add up to the $100 that you paid. And it would take about 12 years to do that, which isn't bad really compared to, I mean, the S&P 500 is around like 15-ish years right now, give or take. Which is very expensive. This is reasonable, I would say. Now, in order to become a buy, I like this to be for a well-established business like this. That's not like a growth business. I prefer this to be like under 10 years. So, like a 9. This will flash 9 when it's barely under 10. So in order to do that, like $325 a share is what you'd be looking at. Not sure how much lower that is, maybe like 30-ish% lower. So yeah, my buy price would be $325. I think it's fairly valued here. Maybe hold it if I owned it. Maybe if I had bought this dip here, that's probably just a hold. I wouldn't get like too excited to sell. However, if we have a recession or things get bad in the industry, we know that the stock price could sell off more because it's done so in the past under those conditions. So it doesn't mean it couldn't fall more. It doesn't mean it couldn't rally back to new highs. I don't really know what's going to happen. I think it's an okay relative value to hold probably here would kind of be what I would be doing if I owned it. I don't see anything super dangerous either. So, it's kind of in the middle there. Let's see. So I gave you my buy price, $325. Let's see if it has traded down. Where did it get to here? Yeah, it didn't quite get there. $390 is what it got down to. So we would need it to get down another level. That's probably still above this. Just slightly below the 2020 pre-pandemic highs. Right? So yeah, if it got right down there, you could maybe use that 340 level, which might be some technical resistance. I'm not a technician really, but that if that high pre-pandemic could be, you might want to start layering in there just in case the kind of a technical bottom forms. But I think it could definitely get down to 325. It could go actually much lower. I mean, if this gets cut down to a 9 PE like it was, it's falling more than 50%. It's getting down 200s, right? Well into the 200s. So I have another recession buy price for that. But just generally speaking, again, taking the sentiment and everything out of it, that 325 level is probably a good spot to aim for, with the understanding that if it's a recession or something bad happens, it could go quite a bit lower still. So maybe half a position there, or start layering at 340 and kind of layer in a few small steps and then wait. If the macro is looking kind of scary, might fall more, you might get a better chance to get some more. Or I like to spread my bets around. So there's a bunch of companies like this. I already own a couple of them. I'd probably keep buying more. The big ones that are in the S&P 500 that have had these great runs have a lot more dedicated investors, I think, that don't want to sell because they don't want to pay taxes on it, maybe, or they just really believe that everything will be okay. The smaller ones tend to get hammered harder, and I like those better because that gives me an opportunity to buy them cheaper. And a lot of times they're smaller businesses, so they have more opportunity to grow. Sometimes. So I tend to like get more opportunities there. But I mean, if a recession came along and these guys got hammered, I would definitely pick some up at the right price. Okay, if you found this useful, hit the like and subscribe button. If you have a request, put it down in the comments. I have a lot of comments I haven't replied to quite yet. I'm going to do that probably tomorrow. Go through my YouTube comments, get all the new requests up on the board. And I am going to start plowing through these. A lot of them are going to be over on Patreon, so make sure to check that out. And I'll see everybody later.